Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today has been investing in real estate for 15 years and built a multifamily portfolio of over 900 units in just 3 years. He's the author of the book, Wheelbarrow Profits, and is a real estate investing coach and mentor. Gino Barbaro is the host of Wheelbarrow Profits, the podcast. Gino, welcome to Purchase to Profits. It's great to have you on the show.
Seth, thanks for having me. Looking forward to a good time here today.
Yeah, I'm really excited. I'm a big fan of the work that you guys are doing over on Wheelbarrow Profits, and I'm honored that to have you as a guest on my show.
Thanks for having me.
Yeah, so to kick things off, tell us about your real estate goals right now. Where do you want to go?
Funny, you should say that. I don't really have any goals anymore. Once you become financially free, everything's icing. The icing's on the cake. My focus really, honestly, is just trying to, our educational platform, trying to grow it up and trying to build it up and trying to get students to get their first deals. Because I know that very first deal, we'll talk about the first deal a little later. It's what it's all about. I mean, we learn by making mistakes. We learn by doing, right? So if you're out there trying to get a 100-unit deal on your first deal and you think you can't do it, well, you're not going to do it. But if you can get a fourplex or sixplex, let's talk about that. I mean, our goals right now, we had crossed the threshold of 1,000 owned units. That's what I wanted to do. I wanted to hit 1,000 units internally. Me, Jake, and my partner own that portfolio. It's not syndicated. We did our first syndication in November of 2018. It was 130 units. We started small with the syndication. We did a $6 million deal. It was just big enough for us. We raised $2 million in 2 days. That was a milestone achievement for us. We'd never raised the capital. Start small. We had a lot of investors on our platform because we had the reach. We had the podcast. We did a couple of live events. We're doing a deal right now. We're in the process of due diligence for $17 million, 240 unit syndication. So, I mean, just to continue to start growing that platform, continue to keep on doing syndications, finding the deals out there. They have to pencil out. It's not about acquisition fees. It's not about asset management fees. It's about returning capital to the investors because my money's in that deal also. And we built up a pretty big platform. So we really have to buy right. And that's looking at a lot of deals. That's underwriting tons and tons of deals. And that's what it's all about. And I guess the other goal would be just to continue to grow our different vertical integrations, whether it's the education company. We're starting to do mortgages with our students. We have the syndication company. We have the property management company, the asset management company. All those different layers have emanated from one single 25-unit deal six years ago.
Yeah, that's an amazing journey. And on your path to hitting those 1,000 units, did your mindset ever change? Because you started off kind of smaller, then you started scaling. What did you have to change in the way you thought about real estate to hit those bigger targets?
Well, Seth, I'm going to say this on your podcast, and I've said it on some, but I'll stress this really, really strongly here. It's all mindset. I went to life coaching school back in 2014. Coincidentally enough, that's when I said to myself, I'm out of the restaurant. I'm going to go into real estate full time. I have 6 children. We homeschool. Did I have enough money to leave? I was about 80% there, but I knew when I burned the ships, that's what it's all about. And believe it or not, Jake and Gino was started for me to learn how to teach people. But actually, once you start doing podcasts and once you start, teaching others, you really have to learn yourself. So it was a little out of my comfort zone. I was doing YouTube videos on cooking and gardening. That's what I love to do. So I'd gotten used to that. And talking about real estate, it's a different skill set, different thing, but I love to do that. So unfortunately, it's all mindset. People can come and tell me, I want to learn multifamily. Okay, I'm going to ask them why. They need clarity. People really need that clarity on what it is they want. When you ask somebody, what do you want? They'll tell you what you don't want. No, that's not what you're going to focus on what you want, right? And if you don't know what it is, how are you going to hit the target? So for me, it's not about the size of the asset, but why are you buying real estate? Why are you buying multifamily in particular? And if you can figure that out, you're way ahead of the game. I went to life coaching school for personal development. I didn't want to become a life coach. That was the end result. Now my wife has gotten her certification because she sees how powerful it is. The empowering questions, the ability to look at, your energy blocks, to see how conscious you are with your thoughts every day, to raise your state, raise your energy levels. It's all there. And if you're a positive, powerful person, you're going to take that into it. You're going to call those brokers. You're going to look at the 100-unit deal. How am I going to do that? Well, let's not worry about how you're going to do it right now. Let's focus on why you want to do it. Then we'll teach you how to do money down. We'll teach you how to do syndications. We'll teach you how to do partnerships. All those tools you can learn. But if you're not ready mentally, you're never going to succeed.
Yeah, I'm really glad you brought that up because, on this show, I interview somebody, a new investor every single day. And it's it all comes back to their mindset, but nobody's ever said it that bluntly. So I'm really glad you brought that up.
Well, it's true. I mean, really, life coaching gets the stigma of, oh, will people pay for that? Well, that's the first thing you should pay for. Don't pay for a real estate coach yet. Pay for a life coach, because maybe, you know what, real estate's not for you. Maybe something else is for you. So really become crystal clear. And a life coach will allow you to do that. They'll give you questionnaires. They'll talk to you. We all have answers within ourselves. That's the problem. We all know the answers. The problem is that we don't have anyone to talk to or actually discuss those. And because we come from a place of, quote unquote, that word fear. But when you're talking to a life coach, my job is to raise your level of energy, to get you pumped up. Positive emotions, as Chris Voss said, leads to higher intelligence. When you have your negative emotions, leads to lower intelligence, which is going on currently in the United States of America. If you have those high emotions and you have that high energy, anything's possible. That's what life coaches are allowed to do. And then you can start thinking internally, well, you know what? Maybe I can find a partner. Maybe I can leave my job sooner. How do we do that? It's all about that, I think, with life coaching.
Yeah, no, 100%. So what are some of the routines that you have, maybe daily or weekly, that allows you to stay focused on that?
Unfortunately for me, I need to be doing stuff all the time. That's a curse for me, because I can't relax. I can't sort of enjoy the day sometimes. I'm always have to be helping people. I always have to be subscribing and achieving. And I tell people, goal is the outcome. Don't fall in love with the goal. Don't fall in love with the 30-unit property. Fall in love with the system or the process that you put in place to get that. So I'm not so worried about having 10 students buy a deal in the next 6 months. I'm worried about how are we doing and how are we implementing our coaching? How are we selling the training? How are we getting the students to take action? If I fall in love with that process, I'm not so worried about the outcome. So for me, daily routines, I try to get up in the morning by 7, try to go for a walk, try to spend some time doing homeschool with my kids, try to do a little bit of journaling, out there creating content. We do usually daily and weekly calls with our students. I'm on level 10 meetings with all of our various team members. The whole day is spent around education, around real estate. So I have a great day. I love my days. And no, weekends are here. I'm like, oh, can't wait till Monday. So I know a lot of people think that's crazy, but once you start doing something you love, dude, I mean, the weekends are an impediment because nobody's working. It seems like we're the only ones that want to work. So it's tough to get stuff done when no one else is out there doing it, right?
Yeah. Oh no, well, for sure. And as you were building those systems and the processes, did you ever go off on a tangent that you thought would work, but it ended up failing?
That's a good question. As far as failing, I mean, you're learning to do systems, and it's always it's always, starting something new. With the education, I floundered a little bit in the beginning. I should have hired sooner. I didn't hire quick enough because I didn't think it was, quote unquote, a real business or a sustainable business. I didn't know that much about sales. I didn't know that much about reaching out and trying to attract people. And once I learned that and I got somebody to help us to do that, I mean, we've been doing great. You just have to get over that mindset of, okay, I have to pay this person to do X. He's worth it. He's going to bring stuff on. So for me, it's like that in business and like in real estate. I was thinking small. I already had the process. I already put those years of work in creating content and doing the podcast and doing the articles. Now it's all about executing and trying to get people into our tribe.
Yeah. And I think that applies to somebody starting out investing in real estate too. You have to think of it as a business right from the start and start laying those foundations for that future growth.
I wish people would more talk about real estate as a business, because in the business world, with an investment, you have a single investment, 25-unit property. We call it multifaceted real estate, multifaceted multifamily, because there are so many facets of driving revenue from that one property, whether it's just on the property itself. You might have a cable contract, you might have laundry, you might have late fees, pet fees, application fees, all those different kinds of fees that are generating revenue on that property. Now let's take it a step further. On that 25-unit property, we had a property management company. So we were deriving revenue from the property management side. We were self-managing it. A year after we created it, we created an education company. All of a sudden, we have revenue coming in from teaching students, right? Writing books, going to do talks. After that, we created a syndication company because we just couldn't deal with all the investors. So we created a syndication company, brought somebody else on. Now we're raising money. We're helping out investors, and we're creating that part of the business. And subsequently, we've also created a capital company where we're doing mortgages for students. So there's multiple ways, and you can take this into any business, whether you're a real estate agent. If you're a real estate agent, go out there, find somebody who's fixing and flipping homes, find somebody who's doing hard money, find someone who's doing an insurance company, wants to partner up with you, whether it's a title company, whether you're doing, reaching out and actually putting things out and creating your whole team. It's all about creating those streams of revenue that's really comes back down to that core business. So for us, I was like the light switch just came on about a year and a half ago. We're like, we have something real here. And if it doesn't work and the education doesn't work, it's okay. It still gives us a little credibility in the space. When we speak to brokers, we have a podcast, we were a best-selling book. It still gives you the credibility. And at the same time, these podcasts are great. You know how it is. And when you get the chance to podcast Robert Kiyosaki for an hour, how cool is that? I read his book 5 years ago, 10 years ago. Now I'm talking to the guy in person. So there's so much you can learn from people. And that 1 hour podcast is just amazing, isn't it?
Oh, it's running a podcast is a little bit selfish because I'm the guy who gets to talk to the guests, right?
I totally agree. It's a lot of work to get these guests. Sometimes it might be hard sending out emails and getting to their assistants and getting questions up and getting the Zoom link and recording and downloading. It can become a full-time job, but it is so worth it because you get so many insights from people who are really super successful and where you want to be. And it's like, wow, I just spent an hour with him. How much would that cost me to spend? Cost me $5,000. I just got it for free, and it's value for value. He's on our show. We're promoting his message and he's giving great content. So I love the space.
Yeah. And the one thing I found is the more successful the person, the more willing they are to share their journey and their successes. I'm not sure if you found the same thing with you.
It's an abundance mindset. People who are successful can think of, and people are telling me, why would you be talking about syndication? I had a meetup last week in Jacksonville. They're like, why are you telling that guy, syndication guy, tips? He's going to take your business. I'm like, listen, there's so much deals out there. There's so much to do out there. I don't even need the deal. If he takes a deal for me, they might be mad for 2 minutes. Let him take the deal for me. I don't really care. But you know what? Chances are he might not take the deal for me. And chances are that if I need to raise money, he's going to come to me because he trusts me and he likes me. People don't get that. And it's hard to get when you're in the rat race. That dawned on me 3 or 4 years ago. I read Bob Berg's book. I'm like the go-giver. I want to do that. I want to help other people out. I want to show them the message, and then they'll trust me with their money. They'll like my message. They'll fall in love with the Jake and Gino brand and say, those guys are out there giving a lot of content, giving a lot of value. And then all of a sudden, okay, we need some money to collect, to raise. They're there.
Yeah. And you had mentioned that you raised $2 million in 2 days, I think you said, right?
Mm-hmm. Yes.
So when you were getting into the money raising mode and you're like, okay, well, we need to raise this amount of capital, were you a little bit nervous before you actually did it?
We had a young guy came on the team. His name is Dylan Marma. He's head of investor relations. I had cultivated the list to about, I don't know, I'd say maybe 400 people, but they weren't all active. Dylan, in the process in June, July, August, September, was creating those substantive relationships, getting out there. That's why it's a tough business to do the day-to-day education, day-to-day property management, day-to-day syndication, because now we have over 700 people on that list. You need to create substantive relationships. So you need to go out there and start talking to people. So he did that. So we were already primed. We were already ready to go. We already had assets that we could show that what we did. So when we went out, syndication is a little bit different because it moves faster. You need to get your documents together. So we had a great attorney, Kim Taylor. She helped us out with the first one. It was awesome. We had all the documents prepared. The soft commitments were like, okay, we know what we got. We couldn't collect money until the PPM went hard. You know how that goes, right? So those are like the little learning steps. It was an accelerated process. We created webinars. So what we did with our students, it was a 2-for-1. We said, if you invest in our deal, we're going to be doing monthly webinars with you. We're going to teach you how to syndicate. You're going to get the education. You're going to get under the hood kind of thing. So we raised the money, $2.6 million in 2 days. Dylan was on a boat. I was down in Tennessee. It was the week before our live event. I'm all cool with the kids. Dylan's like, I gotta get off the boat. I'm getting all these phone calls. So we had the webinar the Tuesday evening, Wednesday, Thursday went live. Before we went to Nashville on Friday, we had most of the money committed already. And it was a great feeling. But the deal, it's an awesome deal. And what we've done is we've done webinars December, January, and February. We have the webinar scheduled in 2 weeks with our investors. We open up the book. We talk about the value adds. We talk about where rents are going. We talk about the management of the property. And we just show whether it's a sign going up. So it's a little bit of overkill, but the students really love it. The investors / students really love it because they get a real deep look at what's going on. And we love it. I love doing these webinars with them.
Oh, yeah. And you just said you're always over-delivering on that information, right? Yeah.
Yes, you have to be transparent because when something bad goes wrong, you want to tell them right away. When something good goes right, you want to tell them right away and be in front of it. So I want these investors to invest in our next deal. So our next deal, we're going to need to raise a little over $4 million. I'm assuming that the majority, if not all of our investors that were in the first deal are going to get into the second deal. I just assume that that's how it is. It's going to be a scarcity. First come, first serve. If you guys want in, you can have in. And then after that, so that's how you cultivate that investor base and you make it more of a culture. And I even told my Josh, our head of community in relations, I said, all the investors, let's give them a discount to our ticket to our live event in October so they can come as a group of investors and say, hey, these are Jake and Gino equity partners. So give them, create that culture and that brand, that awareness. And that's something that is, takes time to build, but anybody can build it.
Oh, for sure. Like you guys are, is it safe to say you guys are brand focused right now?
Yeah, we were in the beginning. I think that's one thing that people do wrong. We started Wheelbarrow Profits. It's a stupid name, but if you know our brand, it's great because it's the form of a wheelbarrow. We have the proprietary framework of buy right, manage right, and finance right. The buy right and the finance right are the two back legs of the wheelbarrow. And if you don't have all three of these stable, your investment's going to collapse. The manage right is the wheel. It's constantly in motion. So that's what we named the podcast, because we wanted to stand out. We're the #1 multifamily podcast out there. That's what we wanted to be known as. Now we do a lot more Gen Biz and all. But then the other thing was Jake and Gino. That's just the name that came out. So that's the education platform. So I think you have to be brand. I think you have to be able to, step yourself apart from others, because nowadays the internet's made everything a commodity. Whether it's money, whether you go on Amazon and buy stuff. So if you want to do a coaching program or something else, you want to stand out as something different. And that's what I think we've tried to do.
Oh, for sure. And I've seen it following your success. I've seen it work, and I've seen your brand grow. So I definitely would say you guys are certainly on the right track. Let's talk about Keystone deals. So a deal that stands out from all the ones you've done. Is there one that made a big impact?
A lot of them. I think all of them have, but let's do the first one, because the first one I think most beginning investors can grasp. We've gone anywhere from 24 units, which is the 25 units, which is the first one. We did a 281 unit deal with no money down. We refied it twice, pulled money out of that deal. That was just an amazing deal. But these little deals led up to that one. So this 25 unit property, we purchased it in February of 2013. It was sitting on LoopNet for a few years. Owners were motivated. They were quote unquote mom and pops. It was listed for $750,000. We offered $600,000. People are like, well, that's a real discount. Can they take it? Yes, if the numbers are right. Don't be insulted by giving somebody a lowball offer. If you can show them the financials and you're pricing it at an actual cap rate, it's okay. A real broker would not be insulted. If you're valuing a property for $1 million, but you're just going to throw lowball in for 800, that's insulting, because at least back up why it's worth 800. For us, we probably could have gotten a little cheaper, but it was our first deal. The income on the property was $160,000. The expenses were $91,000. So the expenses right away, we knew were a little bit high. They were offering cable, they were paying their utilities. So we knew there was a value play on that component. The net operating income was $71,000. Take away the debt of $46,000 and the capital expenditures, which we put around $6,000. The cash flow is $18,000 on this deal. We were able to get this with 10% owner financing.
Nice.
And money down. So we came out of pocket with $600,000. It was $60,000 out of pocket plus the closing costs, which came out to $81,000. So $18,000 in cash flow divided by $87,000 out of pocket. Cash on cash was 21%. I mean, it was a fantastic deal. But why? It was 25 units. It was a typical fixer J. Cottages, single home families. It was just a 25 unit property, mixed use. It was a 6-unit efficiency. There were weekly renters. It was tough. There were bed bugs. One lady passed away on the property 6 months after we bought it. The septic fields failed. It was a lot of work. It was a value add, heavy value add. But what was great about it is we learned how to deal with the property management. We learned how to implement systems. We had a resident manager that we hired. We put in our own website. So we grew from that property. 18 months after we owned it, we were able to pull out $160,000. We refied it. It was worth $825,000. So people say, well, what happened? Did your mortgage go up? On this one, it didn't, because we got terrible terms in the beginning, because what happened was we got the owner financing and the bank had the note from the previous seller. So we had 6% interest rate. We had a 20-year AM. We had a 5-year term. When we refied it to a 25-year AM, which allowed us to cash flow more. We got a 4.19 interest rate, and we got a 7-year term. So basically, even though we pulled out a ton of money, the payment was basically the same. And remember, NOI goes up because we were able to cut the expenses and increase the income. And we've been able to do that on all of our properties. We've been able to refi out almost $9 million in the last 5 years on our deals. So there's bonuses to owning your own stuff, and there's bonuses to refining. To syndicating. We were just buyers and holders in the beginning. We just kept refinancing that money, repurposing it to the next deal. And that's how we were able to grow our portfolio.
Yeah. And you had mentioned this deal was stagnating on LoopNet. Why did you see opportunity when everybody else out there missed it?
We had a good broker, and we still work with this broker 6 years later. He helped us with the owner financing component of it. Sometimes value is just staring you in the face, And I can even give you an example of a property we closed in December of 2017. We had seen this property 6 months prior. It took me Hurricane Irma to drive back up to Tennessee and go look at the property with Jake. I spent a week with Jake up in September of that year, in 2017. We went back to look at the property. Deals need to have problems. This property had an HOA component with condos. So buyers could not get that agency financing that they wanted for that component. We got community financing, and we're actually refining that to a life insurance company. But on the front end, it was hard to do that. So all these properties, and this first property in particular, not very attractive. Needed a lot of work. The stigma of the property was terrible. Had a great location, drugs on the property. Took us 6 months to really clean it up. When the mail lady comes and says to you, it feels safe again to deliver property on this thing. That's what makes these deals really exciting and enticing. But you need to look at the value component. You can underwrite a property today based on actuals, but if there's no value component, whether it's increasing the income or decreasing the expenses, it's really hard to make money in real estate. You need a motivated seller. That was the thing. The seller is motivated, and maybe that high price is the broker who was listing it. That was his mistake. When you put a property on that high, people are afraid to come in and say 600. On our third deal, the sellers had a property on the market for 5 years on LoopNet. It was floundering. They had it listed for $6.5 million, and that's what it was worth repositioned. I offered 3.7. It took a lot of courage. They came down to 4.4 on their first negotiation. And why did they do that? They were motivated. They had it on LoopNet for 5 years, and they knew that they were overpriced. But that was their mistake. If they put the property on the market for $5 million, maybe they would have sold it for 4.8. We settled at 4.075. Took 2 more months to get there, but I knew that's what the value was. Don't be afraid to put in offers that make sense.
Yeah. And you stuck to your guns in those situations too. You didn't let the sellers, pricing affect what you were willing to pay for the property.
You have to be willing, patience, persistence, but willing to walk away as one of the things that I learned. And I made mistakes in my previous career before I started buying with Jake, but I learned one thing: no deal is better than a bad deal. Because I bought a deal back in 2007 in New York. I had it for 10 years. I just actually started to speak to the property manager today. I sold it 2 years ago. I lost a ton of money, but for 10 years, it was a time suck. It was a soul suck. And I was working at the restaurant at the time. I didn't have time to deal with this property. I bought it wrong. You need to buy these properties right. And we're at the point in the cycle that if you buy them wrong, you're going to be holding on to these things for the next 10 years, if you can. So it's all about buying on actual numbers, being able to add that value, and being able to, whether you're going to sell it or refinance it out, being able to, when occupancy goes down to 90% or 88%, if you can pay the mortgage, you have to build that into your calculations.
Yeah. And you mentioned where we're at right now in the cycle. We are in March 2019. What are some of the things that you've changed with your approach just to make sure you're buying right in today's compressed market?
It's a great question. We had stopped buying property deals in end of 16 and 17 because we weren't following the market. We were used to buying at 8 caps. We were used to buying at 10, 12% cash on cash returns. Those are the only metrics we knew, until we said to ourselves, well, why are we buying these things? We're buying these things for maybe a little cost segregation, which is awesome, but we're also buying them for the value add component. Can we add another 10% on fees? They're only getting 2% fees generated. Maybe I can get another 8%. We're running these at $4,000 a unit. Why are these guys running on $5,200 per unit? There's value adds right there. Can you add additional units on there? Are there additional ways to scale the business? So those are ways that we're trying to buy them right now. We're trying to buy them smart. We're trying to buy them at the actual cap rate of what's going on in the market. And we're trying to buy assets. We're in the C space though. We still like C properties. We still like the workhouse affordable, because the top tier market properties right now, there's a lot of deliveries coming online. And I'm afraid with the absorption and with the economy slowing down a bit, if you don't have that robust job growth, you're going to get stuck with those properties. And that's not going to affect the C as much, because an A tenant is not going down to a C. He might go down to a B plus or B, but he's not going to a C. So we're sort of still insulated in that aspect of it. So we're looking for still C, C plus, B minus assets in areas where we're within 3 hours of Knoxville, because we're vertically integrated, because we're managing our properties, we're doing everything to our properties. So we want to stay within 3 hours of Knoxville. And we're blessed because you have parts of North Carolina. We have deals in Louisville. We have deals we're looking at Chattanooga, all those markets where there is job growth and there's population growth. So we're lucky in that respect.
Yeah, no, for sure. And just to go back in time, you're working at the restaurant, you're dealing with that horrible purchase in New York. Since then, how has real estate changed your life?
It's been, for me, radical. As far as the tax consequences, it's been fantastic. As far as my life, I've been able to leave New York. I left New York in June of 2017 and moved to Florida, St. Augustine. I actually moved here because I wanted to buy assets in Jacksonville, but I found the same trap that I did. I was looking at them when they were 7 caps. It took me a year and a half to get down here. All of a sudden, they're 5 caps. I'm like, I'm not buying a 5 cap property. I fell into that trap. But if I'm buying a 5 cap with value add that goes to a 7, and then I can refi it to a 6 or a 5, I should have done that, but I fell into that trap. So, real estate's allowed me to do everything. It's allowed me to create multiple businesses. So Jake is doing day-to-day property management. I can do day-to-day the education. So it's allowed me to create a great team, great vendor list, great sponsors, be able to do live events, be able to work whenever I want to. So it's been an amazing, for me, it's been an amazing journey the last 3 or 4 years. And it's funny because everyone says, well, he can do it. I was stuck doing something for 20 years. So I had all those limiting beliefs. And if I was doing that for 20 years and I only had one restaurant for 20 years and I was good, we had a good little place. And then in 5 years, it's going to be 1,400 units in 6 years coming up. How did that happen? I didn't come any smarter, right? I had more experience maybe, but I was just looking at stuff from a different lens and from a bigger lens.
Yeah. And now you mentioned Robert Kiyosaki, you had Grant Cardone on your show too. You've been rubbing shoulders with some pretty high profile people. And
it's a lot of fun to talk to them because you know what? I realized they're the same as you and me. They've just figured out business. They figured out systems. They figured out how to hire people. And when you talk about that, it's leverage is really powerful. Not only leveraging money, but leveraging other people's time and other people's resources. That's why when you have great employees, if they can 3X or 5X what you're doing, you pay them gladly. But when you're a mom and pop, you don't look at it that way. You're only looking at the bottom line. You're looking at the cost and not the investment. That's the big difference between these guys who are so successful and us mom and pops who are just looking at it and going, you know what, how much did I make this week? They're not looking at how much did they make this week. They're looking at how much did they invest this week and where are they going to grow to? That's the big difference between I see people who are so successful and people who are just, scratching by. That makes sense?
No, that makes perfect sense. And I think you put that very succinctly. So Gino, if somebody's looking to get involved in your education program or invest in one of your deals, where can they find you?
Sure. Just go to jakeandgino.com. You can click the button that says apply to work with us. We'll have somebody reach out to you as far as getting mentored by us. Also, there's a button that says invest with us. Go on there and click the button to invest with us. Check us out at our podcast, Wheelbarrow Profits. And my email is gino@jakeandgino.com. I'm really accessible. Call me anytime you want. You have any questions, send a deal over. I love talking real estate. So, anytime, I'm always accessible.
Yeah, no, that's great. Well, Gino, I really enjoyed our chat today, and I really appreciate you taking the time.
Thank you very much. Have a great day.
Yep, thanks. And to you, our viewers, I wish you well on your journey from purchase to profits. See you next time.